This is a private screen share, a live screen share that we're doing. We're at the very end of our screen share, but I did have this question and I want to, highlight the importance of understanding leverage. Leverage can wreck you really, really quick, or it can make you a lot of money. And I strongly recommend, if you don't know how to trade leverage or don't know the ins and out of it, trade with very little money, $10. Like, you don't need to brag to other people how much money you made. What you want to do is you want to have your profits consistent. 4%, 3%, 20%. Who cares about the 80%, the 120%? Who cares about that? I don't. Nobody. I just want to see that you're winning. That's all I want to see. So for everybody in the group, I do thank you very much in the VIP group. This video is also going to be for the YouTube members as a special thank you for being a member. What I want to point out really quick, they sent this at 12:03. I'm in these charts all the time. I'm on, I'm doing this literally almost 24/7, unless I go to sleep. And it took me about 3 minutes to record the video. So if you do the math, it literally took about 2 minutes for me to respond. On average, I respond within 10 minutes, unless I'm, doing a YouTube video, update video for the members, the VIP members. If I'm doing a screen share for them, if I'm doing just charts or another maybe live stream. So there's a lot of things that might hinder, and it might be an hour, maybe an hour and a half, which in my opinion is still really great. Let me know, of course, for everybody watching this on YouTube, let me know in the comments if you think that's good as far as a response time. Usually within an hour to an hour and a half, but on average, which happens a lot, it's within 10 minutes. So let's look at this and let's just kind of go through this. What are they talking about? Let me go ahead and change this to an arrow. So right now, they're saying, hey, Joe, got a question. I'm seeing your stop loss. They're about 5 to 11% on a few of these trades. So this is what I try to do. I try not to go too deep on the percentage. If a guy was using 15 to 20x leverage, which this doesn't matter. Your stop loss is what matters. And we're going to go over that in just a second. Would you suggest slacking off a tight stop loss and letting the trade play out? There are times where we get stopped out, like really quick. I wouldn't say really quick, but there are times where we get stopped out because our stop loss is so incredibly tight. Seems like there is almost always a dead cat bounce where basically it just, does kind of like this number, just lower lows. If we're going high, if we're doing longs, we might see something like this. That can stop you out with high leverage and a tight stop loss. So again, low stop loss, high leverage, you get dumped, you get wrecked. I feel like I don't have much choice but to give myself 20 to 40% stop loss. So if you are doing a 20 to 40% stop loss using 20x leverage, you are getting liquidated like 5 or 8 times. Again, not good at math. I'd have to see it, kind of think about it. But this is saying, let's say you entered a trade and it moves. It doesn't have to move the whole. Let's just say you went 20%. Let's just give you the benefit of the doubt. You went 20%, or yes, 20%, and you did a 5x leverage. You don't even have to move the whole 20% to get liquidated. So we're gonna draw this out and just kind of talk about it. And then he goes on to say, I guess the part of high risk, I guess that's part of high risk leverage. For me, I trade higher leverage all the time because again, the leverage doesn't matter. The stop loss is what matters. We're gonna go over that. What's your ideal stop loss on higher leverage? I've been doing 10 to 20x, but I think I might move down to 5x. Okay, great question. Absolutely love this. So let's work this out. Let's say we are in a trade and we have this as our setup. Now, there's a couple different things that we can do before we enter this trade. One, the very first thing is, where is our stop loss? The leverage, so this is the leverage, I can spell leverage. All right, so we have our leverage, our percentage of stop loss, and then the percentage. I'll explain this in a second. So what we're doing right now is we're going to enter this trade. The first thing we have to do is we have to see what is our stop loss going to be. Are we going to have our stop loss just underneath this, where we're going to use this as support? Or are we going to have it underneath this level right here? Or are we going to do it underneath this whole zone? This whole area that we have right here. If we have it, and the reason we're looking at, because this is most important, where is our risk going to be? So this right here is our percentage of risk. Are we going to be very, very risky and have an extremely tight stop loss? If we do, we can increase the leverage if we want, or increase the margin. The margin is the most important factor of all of this. This right here is number one, because this tells you how much money you're going to be putting in depending on the leverage, which depends on the stop loss, and your risk. Are you increasing your risk or decreasing your risk? So let's say we have a stop loss here. And on the stop loss here, we have 3%. So for this 3%, so we're willing to risk, and I'll just do it right here, we're willing to risk 3% of our stop loss. So this is 3%. I can go, let's say I can do, if you want, you don't want to get liquidated, that's for sure. And just know that the higher leverage you go, the less margin you're going to have in the trade, the higher the fees. And why are the fees higher on greater margin or on less margin? It's because you're using less money and you're borrowing more. So I hope that makes sense. And because you're borrowing more, well, you can just call it interest rate, or your loan amount has increased. And when you use lower leverage, well, you're using more margin, more of your own personal money, which reduces the amount of loan fee because they're giving you a less of a loan. Here, you could do 5x leverage. You can do a 20x leverage, but just know that 20x leverage, that's 60% of your margin. So because of that, that means you're going to have to use a very little margin to not get stopped out. But the main factor of all this is when you move your margin, what is your risk, the amount of money? Let's change this to money. What is the amount of money you're willing to risk? For simple math, let's say our account is $100. I always recommend only risking 1% of your portfolio. So this means you can only risk $1 of your trade, or for your trade. So the leverage doesn't matter, the stop loss doesn't matter, nothing matters. This is what matters. Your risk, 1%. Now, the most important part of this is how much margin are you putting into the trade? You can only put in enough margin to where you are losing only the max of $1. This is not sexy, guys. This is very boring. Because when you win, because you're only risking $1, depending on your leverage, depends if, let's say your margin you put in for this particular trade is $7, or maybe it's $2. So with the higher the leverage, the less money you put in. The lower the leverage, the more money you're going to put in. So let's say we did a really low leverage at 2x or whatever it is. Here I may be putting in $23 and my leverage is really low. But regardless of how much money I'm putting in, regardless of how much leverage I'm using, regardless of my stop loss, like all of these are key factors, but the most important component is this. How much am I willing to lose? $1. So what you could do, set your stop loss. And let's say you did it down here. Let's say you did it way down here. And you are very highly convicted in this setup that there's a lot of areas for potential bounce. And let's just say we're in a bullish market. Could you potentially have a really low stop loss? Sure. Just know that this method is successful, but then when it fails miserably. Let's say it does come down and your stop loss is way down here, but you have another entry right here. And here you were willing to risk $1. And now, same thing, you're not in other trades. This is really important. You can't be in a lot of trades because every time you're in a trade, you're risking $1, then the next one 99 cents, the next one 98 cents, because you're reducing the amount of money based off of your available balance. Then, let's say here, you can only risk, let's just say 78 cents because you've been in other trades, maybe the other trades you've been losing. So when you enter here, you can have the same stop loss just to make it, you can have the same stop loss to make it easy, same percentage of leverage, same everything, or same X of leverage. But when you have your entry here, your stop loss is here, but you're only willing to risk 78 cents on this. So in essence, what you're doing is you're lowering your average entry to, let's just say here, simple math. This isn't just simple math. I do have a video that explains this in great detail, and that is the advanced trading for leverage. You lower your average entry. So as soon as the price starts coming up, now instead of waiting for here to be in profit, you're now in profit here. And then as it continues to go up, now you can get your stop loss and potentially move it into profit. So now at the very worst, you cover your fees and you make a few dollars or a few pennies, depending on how much money you're putting in. So to wrap everything up, I know this was kind of a longer video. To wrap everything up, your leverage doesn't matter. And it took me a long time to understand this because there are times where I'm doing leverage of 3x and I would only do 3x. And there are times where I would do 20x or 50x. And you'll see it too, like on Bitcoin, I'll do 70x leverage, but I'm only risking $1. The leverage doesn't matter. Where is my stop loss? And then based off of my stop loss, that tells me how much leverage I can use depending on the margin amount. This right here is what matters. And just kind of see if what I'm talking about works. And you'll see that when you lose, it's not as bad. Let's again, you had $100. Let's say you lost a trade and you're not using this method, you lose $8. Next method, you need to lose $12. Next trade, you win $18. Next trade, you lose $40. That's not, you're going to wreck your account. But if you lose, and every time you lose, it's $1, 99 cents, 98 cents, 78 cents because you lost a whole bunch in a row, eventually you're going to start winning. Now, granted, it's much easier to make a lot of money with a lot of money. And it's very difficult to make a lot of money with very little money. Like the market is literally set up for it to be the advantage, to have the advantage. It's like going to Vegas. The house has the advantage. So the only thing we can do is have more opportunities to actually trade. And that's what we're doing. So if you have any questions on this, definitely put it. This is for my VIP members. If you have any questions on what I just went over, make sure to put it in the VIP chat. If you have any questions on anything, make sure to put in the VIP chat. Not only myself, but our very talented admins will help you out. In addition to our members, we've had members for a very long time, and they are absolutely killing it with the thought process. You know, some they've acquired the skills a little bit faster than others, just because one, either their learning ability or their amount of time they have into learning and attending these live screen shares and watching all the live streams, also watching all the private videos that I have for the VIP group. Like, all that truly does help out. So this again is for the YouTube members. I do thank you very much. Make sure to smash the like. Also, leave me a comment. Let me know you watched this video. Let me know if it made sense. And let me know what you thought of the video. Thank you so much. We'll see you in the next one. Take care.